financial habits you form in your 20s can have a massive impact on life in your 30s. And in the same vein, the financial mistakes you make now can end up being quite costly down the line. So in this video, we're going to go over those common but costly financial mistakes to avoid making in your 20s. If you find this video helpful, don't forget to toss it a like and subscribe to my channel for more videos like this one. The first money mistake I'll talk about is racking up credit card debt. While credit cards are a useful financial tool that can help you build credit, they need to be used strategically and with discipline. When you have a credit card with a balance that you don't pay off within the month, the credit card company will charge you interest on that money you owe. And while most loans have rates that are usually under 7%, most credit cards charge really high and expensive interest rates, typically above 20%. And on top of this, leaving a high outstanding balance on your credit cards can hurt your credit score. One of the biggest factors of your credit score is how much credit you're currently using. This is known as your credit utilization rate. Your credit utilization rate is calculated as your total outstanding balances on your loan divided by your total limits on your loans. If this number's too high, then it'll hurt your credit score. Typically, credit score providers like to see this number below 30%. So to avoid racking up credit card debt, you should always pay your credit cards in full every month if you can, and keep your credit utilization rate below 30%. And that's a great segue to the next common money mistake to avoid in your 20s, which is ignoring your credit. A lot of people ignore their credit either because they don't know what credit is or because they don't benefit that much from having good credit. But building good credit in your 20s gives you access to a lot of financially beneficial things in your 30s and beyond. For example, when it comes time to buy a house, a good credit score can save you thousands of dollars on a mortgage. It can also give you access to way better credit cards or even better terms on car loans. And if you ever need a loan to start a business in the future, having bad credit makes this much more difficult. Now, the most common credit scoring system is FICO, and they define a good credit score as anything above 670. But you really want to be at least above 720 to get those benefits I mentioned, like better interest rates, loan terms, and access to better credit cards. Some things you can do to improve your credit score over time is paying your bills on time, keeping your credit utilization low, avoiding checks on your credit through loan applications, and keeping your old credit cards open. Now, we've gone over some common money mistakes with regards to spending, but it's also easy to forget about saving. So the next common money mistake that I'll talk about is not having an emergency fund. Emergencies happen, but when you're young, it's easy to feel like bad things won't happen to you. And I'm not just saying this, I have to actively remind myself of this all the time. Your emergency fund should be an easily accessible cash reserve specifically set aside for unplanned expenses. And it's typically recommended to have 3 to 6 months of living expenses saved in your emergency fund. Keep this money separate from the money you use for everyday expenses. You want a stable account that lets you withdraw your funds quickly in case of an emergency, but still earns good interest, like a high-yield savings account or money market account. And on the same vein of saving, another common money mistake to avoid in your 20s is neglecting to save and invest for your retirement. No one wants to be forced to work forever, and the earlier you start planning financially for your retirement, the better off you'll be. Because of the effects of compounding returns, starting your investing journey even a few years earlier can have a massive impact on how much you're able to save for retirement in the long run. So definitely don't put this off. And if you're ready to start investing but don't know where to start, check out my other video about the optimal order of investing. The next common money mistake to avoid in your 20s is being too shy to negotiate your pay. When you're fresh out of college or have limited experience, it's easy to feel like you have to take what you get. But when you get a job offer, not asking if the salary is negotiable only hurts you, since the worst that can happen is that they say no. And to put numbers to this, according to salary.com, not negotiating your salary can lose you an estimated $500,000 in lifetime earnings. Now, I'm not saying go out there and demand $1 million salary for a job paying 80 grand, but at least make sure you have an idea of what your position typically pays in your city by using sites like Glassdoor or PayScale so that you're sure you're getting paid fairly. And in cases where your salary might not be negotiable, don't give up. You might be able to negotiate terms outside your salary, like a bonus or stock compensation, or even benefits like extra vacation or remote work. Making money mistakes is common and inevitable, especially when we're young. But being mindful of the common money mistakes people make in their 20s can hopefully help us avoid making those same mistakes for ourselves. So with that, thanks so much for watching. If you enjoyed this video, don't forget to smash that like button and smash that subscribe button for more videos like this one.